Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth. Hope you'll check us out at jazzwealth.com. We are financial advisors that will work with you no matter how big or small you are. We don't care. And we actually use Goldman Sachs as our custodian, which, you can't knock on their door. They're going to ask you to have $10 million or so. Hopefully you'll check us out at jazzwealth.com. Hey, tonight we are trying old Bullet Bourbon. Not my favorite, but I saw it there and I was like, let's change it up a little bit. I like Bullet Rye in an old fashioned. Bullet on its own, that's about as much as I can take, but there's nothing wrong with it. It's just, I don't know, it's not amazing. I mean, Eagle Rare, that's amazing. But of course, the price difference, right? Anyways, grab a drink and hang out with me here for a moment. We are going to discuss recession or no recession. And remember, we're going to dissect the economy from the stock market. The stock market is a leading indicator of the economy. The economy is a lagging indicator of itself, right? So one of the things I want to point out first, and I've done a lot of this with clients. We do an email, it's called Notes from Jazz. So every week I send out an email, and I try to illustrate things that you're just not going to find anywhere else. Well, one of the things we pointed out, this is not new data. I'm going back a little bit, but I'll make a point. One of the things from a stock market perspective is you have to expect that the stock market is likely going to underperform its long-term average, right, this year. Long-term, going back to 1953, the stock market's returns are about 9.21% average per year. Not every year, that's just the average. So when people say like, expect 7% returns in the S&P, what they're saying is, well, we got about 9.2, 9.5% average returns. Back out inflation, you get yourself about 7%. That's how you come up with that. So we've had something interesting happen last year. Do you know what the 200-day moving average is? And this is just one of many things that I've shared with clients, but the 200-day moving average is a really popular metric for the mid to long-term investor. It's a way to see what did you pay relative to the longer term average price. It's not a magic trick. There's no secret sauce. It's just usually a line on a chart. And all it does is it just plots the average of the last 200 days. There's nothing else to it. Well, it's kind of cool. You get to look at it and go, I am paying more than the average price over the last 200 days. If you're okay with that, you do it. If you're not, you wait. Well, last year, 2024, the S&P traded over or above the 200-day moving average in every single day of the year. That's the 11th time that's happened. Okay, that's odd, right? 11 times that's happened. How many years has the S&P been around, right? So you got to think about that. You go, okay, well, that is a metric that's odd. And I like to find those things. We go, oh, that's not normal. Well, tell me the last 10 times that happened. Was it a good thing or a bad thing? Give me some data. So let's take a look. All right. 2024, 100% of the time, the S&P traded over the 200-day moving average and by an average of 10%. Here's all the other times that happened. Okay. Not every year is negative, by the way. The average performance was about half of the average performance of the S&P. It doesn't mean that it can't be. You're not going to have this 20% gain, this 26%. These are back-to-back years of more than 20% gains. But you're not going to have multiple years with it. We already had it. We just had 2 years where that happened. We just don't see 3, right? So the average performance is for underperformance. It doesn't mean the market crashes or, whatever. It just means, hey, that's the average there. Now, on an economic standpoint, there's people a little bit concerned out there. Consumers and investors, as well as the Federal Reserve. So let's go over that. If you look up Google Trends, you can find this data too. How many people are searching for recession? Ooh, not looking good, right? That's a big spike. Let me get myself out of the way. Doo-doo. That's good enough. So the number of people searching for recessions has hit the third highest point ever. Okay. Does that mean we're going to have a recession? No, but it means that people they're concerned. Why are they concerned? They're seeing things on TV. They're seeing their wallet. They're seeing the prices of homes. They're starting to see a little bit of a pullback in some of these prices of homes. They're starting to see more cars on a car lot, right? They're starting to see their credit card. Maybe, I should probably work on that. That's a higher interest rate. I'm not really interested in that. That's just people searching. What about people betting? Did you know you can pretty much bet on anything these days, right? Here, I'll just show you. There are more people betting on recession here. We have 42.5% of bets are betting on a recession. So this is Polymarket. If you're not familiar with that, you can grab the data from them. But okay, that's pretty freaking high. What are they doing? They're not searching. They're using money to bet. So that's why you'll see on TV, they give these people more credit because they're actually betting their own money. Now, I put a note in our Notes from Jazz. Could that not be a hedge? Think about that for a second. You have a portfolio in the stock market. And if you're familiar with hedging, you might have various strategies you use to hedge your portfolio from a downturn if there's a recession or if they coincide. So if you wanted to hedge right now, if you wanted to hedge your portfolio, it wouldn't be worth it. It's too expensive to pay or to hedge by more than 30%. So in the stock market or the traditional way that you'd hedge a portfolio, not really good. Is that something where you could go to something like this and bet on a pullback in the market, place less dollars on that bet, and hedge your portfolio for a smaller percentage cost than you would if you used, I don't know, the VIX or some put options on the S&P? Well, you wouldn't want to do that right now. You're paying a whole lot of money to do that. So I thought that was really cool. It was just a side topic. But anyways, people betting on recession here. Now, we have another issue. The Federal Reserve, I think it's Kansas that does this. They do a study and they go, what's the probability of a borrower, me and you that have debt or something, right, missing a payment in the next 3 months? This is the highest February on record where the probability of them missing this is the entire lifespan of this, by the way. The probability of someone missing a debt payment is the highest in a February that it's ever been. It's also elevated overall. We've got a little bit of a problem here. There is a higher probability that people miss a debt payment. What does that do? It starts causing issues with the banks, not necessarily catastrophe, but this is something that they monitor. Helps them make their decisions. And one of the fun things, do I have it? Let's go. Oh, this is not fun, but here it is. We're looking at the percentile of the probability of them missing a debt payment. So if you're under the age of 40, the probability of you missing a debt payment right now is in the 93rd percentile relative to its somewhat short history, but still, it's what it is. So you could look at this and go, oh, if you have a high school diploma or less, and you are, where are you here? In the Northeast, are not looking good for you, right? But what I want you to look at is, look at the elevated probabilities of them missing their debt payments, by percentile anyways. Oh, wow, we have a problem. It's not like we're saying those that are high school diploma or less and in the construction industry have the biggest. Okay, well, it's not limited to one industry. It's now getting widespread across all borrowers in all regions with all income levels and all education levels. So that's a bit of a problem, right? So what do you do about this? Like if you're saying, okay, I don't like what I see on TV. I don't like these stats that we're seeing here. I'm worried about a recession. What do you do with that? Step number one is to make sure that you're only using the dollars that you need to get to your goal. And if your goal is retirement or buying a house in 5 years, it doesn't matter. Only use the dollars you need to hit the goal. So many people randomly save 5% in my 401k. I don't know, it seemed like a good number. 7%, whatever it is. I got a raise. I moved it up to 8%. Let's figure out that number first. That's something we do with every client is go, I don't want you saving more. I despise advisors that go, you need to save more. Yeah, well, what's the number, right? Like, how did you figure out that number? Help me understand why you came up with $267.50 a month. Why wasn't it $250? Like, tell me how you came to that. So that's step number one, because you're likely saving too much. Believe it or not. I mean, we've got thousands of clients all over the country, and I find that they're usually saving too much. They think they're supposed to put so much in their 401k, maybe a Roth 401k, an HSA, and then their IRA or Roth IRA, and maybe some brokerage accounts as well. There's a lot of money moving around for each individual person, whatever a lot is to that person. So you figure that out first, because if you can find that you can free up dollars there, that's more attractive than stop going to Starbucks. I don't know. kind of addicting, right? It's like if you can keep doing that and pull dollars from somewhere else without worrying about how many subscriptions you have or do you have a budget? I don't care. Start there. All right. Step number 2 is to look at the investments that you have across everything and go, am I invested the way I need to be to hit that goal? If so, you can turn away, right? And the market goes up and down and, you just don't even care really because you know you're on track for that goal. The dollars and the investments are going where they need to go. So a recession is more personal because maybe you lose your job, right? But if you know that's on track and go, I have money, I have areas that I can pull and stop and start and all of that. So it's less about the budget. Be careful when you get into, I worry about a recession, so I'm going to cut back on my budget. All right, well, maybe you get to that, but first start with the dollars that you're automatically saving everywhere and work from that. So we'll cover some more of that in another video there, but I just thought that'd be fun. Let's talk about that for a little bit. As always, this is shared with our clients at jazzwealth.com. If you want to work with us or move an account over to us, you want to know your number. We'll work with you. We don't care. We're not going to say it costs you a lot of money. Everything is right on our homepage. We were ranked the 66th best advisor in the entire United States by USA Today, and we didn't get there by hiding stuff, right? Like to be transparent. You should know what's going on there. Hey, thank you for watching, and maybe you'll hit the subscribe button if you just like me, but you're like, I can do this myself. I don't really want you. A little thumbs up, a little subscribe. That'll help us out a little bit too, and I hope you learned something.